EBITDA is one of two numbers that you multiply together to get the value of your company. It's used two places, one for valuation of a business, and the other is how banks measure your profitability.
Our listeners, their business is probably, in essence, their retirement plan in one way or another, or has a large contribution to their retirement. And if you're not focused on EBITDA and you see your business as a retirement plan in most cases, then you're missing the mark.
Less stress, more time, more money. Welcome to the Cash Flow Contractor Deep Dive.
Martin, how many of your clients walk in and tell you what their EBITDA is?
Let me see. Trying to think. None.
Zero. You have that, I don't know if it's a painting, I guess, of EBITDA. What is it?
Oh, yeah. Yeah. Well, it's done like a Roman mosaic, tile floor, whatever you call that, mosaic. It says EBITDA facit. And the Latin facit means made this, caused it to happen, whatever. So anyway, nobody ever gets it. I'm surprised nobody ever notices that painting.
I
thought it'd make
many
a
times.
good bumper sticker or license plate. EBITDA facit. Sounds kind of classy.
Well, I think for a lot of our listeners, they operate in the world of top line revenue. That's what they're thinking about. Mm-hmm. And some may be thinking about margin, profitability, and doing well there. And very similar, but a completely different thought process typically is thinking in terms of EBITDA. We'll define what it means and we'll go through all of that. But who are the people that think about EBITDA in your eyes the most? I'll give you my answer in a second.
Well, I think you just nailed it. The evolution of a business owner, when you start out and you're thinking mostly about operations and trying to get some money in, you're at that level of, what's business and how do I make sales and how do I hire people? So you're doing most of the work. So you're not leveraged, meaning if you don't work, you don't make money. Then you move up to the manager, you hire some people and you make some money off of their hours, theoretically. Then you move up to, I don't remember what we call it, but an owner where you have a manager who does that for you. But there's a definite evolution of where you're concentrating on the business and different parts of the business, from sales to margins to profitability, to eventually reach the point where you're talking about the value of the business. And it is a wonderful thing to see. And I've had it happen very recently, just in a remarkable way, but more than once. People transition from that day-to-day slog, sales, expenses, trying to make money, deal with customers, of an operational business owner up to the point where somebody's thinking about the value of the business, improving the value, and then ultimately selling the business. And when somebody's at that level, I'm going to say generally they've mastered the things below, right? Mm-hmm. Meaning, but they are at a different level and life is different. Life is completely different when they wake up in the morning. And probably the imprimatur of somebody who is at that level is somebody who understands what EBITDA is and how it's used. So are we close on our definitions or?
No, absolutely. I mean, you went way more in depth than me. I think of investors. I think of private equity. I think of investment bankers. I think of business owners who have been around the block and been in multiple businesses before. That's really what I think about with most people that are focused on EBITDA. They're playing a different game. They're totally playing a different game, and they just see, I think that's where America has done extremely well with business, is the finance side. And I think, you see all these startups and Silicon Valley companies, SaaS companies, big marketplace apps like Uber and Airbnb. And I feel like, especially for the younger generation, they've kind of, for the past 10, 15 years, really ruined how people perceive the value of a business. because it was growth at all costs, and they could be losing
Oh,
billions of dollars in a year, but have this valuation that was insane. And I think there's been like a reckoning, especially as we've dealt with COVID and as we've dealt with inflation. You have all of these companies now focus on EBITDA again and focus on their
man.
profitability. And so I
You're,
think at the end of the day, that's what's true. And that's what is really going to matter, not how many users you have and your total addressable market and your brand. I mean, those things all play a role in valuations, but not nearly as much as they've been overvalued in a sense by so many. And so people have a misunderstanding of what true value is in a business.
yeah, we're really kind of talking about two different things.
Oh, yeah.
The Silicon Valley stuff, these guys are gold strike guys, you know.
Yeah.
They're venture capital, invest in 10, going to lose in 9, going to make 100,000% on the 10th one, you know. They're Amazon, you know, where the valuations were going out just in outer space and they hadn't earned any profit. You want to be the next Uber, the next Lyft, the next Airbnb, the next, just all of those, what do they call them? Disruptive technologies that change the way the world works.
Yeah.
And those are out there. And you want to talk about an interesting podcast we need to do. We need to talk about financial engineering versus business operations. Okay.
Yeah.
And it's really cool. It's really subtle, and it can be really, it's a puzzle. I mean, it can be ethically and, well, it's all legal, but is it ethically, you know, is it a create value? Anyway, there are a whole bunch of really cool things. But I think for our purposes today, we'll talk about somebody who's one of our listeners who's got a business. And I don't care if you're doing 5 million a year or 10 million a year or 25 million a year, but you've worked hard, you've built something up, and now you want to value it. EBITDA is a method of value. It's used two places. One for valuation, okay, of a business. We'll talk about how you do it. And the other is how banks measure your profitability, okay, for lending you money. Okay, they look at your bottom line, but they look at some other things. Generally, those other things help you. But anyway, so that's the two main uses: valuing your business to sell, and then as a measure that bankers can use to look at the robustness of your profitability, right?
Yeah. Well, another thing I want to bring up for a lot of our listeners, their business is probably, in essence, their retirement plan in one way or another, or has a large contribution to their retirement. And if you're not focused on EBITDA and you see your business as a retirement plan in most cases, then you're missing the mark. But EBITDA is the number, is the what you need to be focused on if you do see it as your retirement plan, because then there's other things, but that's going to help you actually be able to retire. Is if you have really good EBITDA, obviously your multiples are going to be huge.
If you want to sell it.
If you want to sell it, correct.
Yeah, there are retirement plans that involve having really good people working in your business, bringing them on, and you continue to take money out of the business.
You're a
if you're doing that, you're still going to be in. But if it's your business, you're going to be involved. You won't be completely out.
Mm-hmm.
But you're right. If you want, you said the same thing I would have said, but he said it's a retirement plan, and I go, well, it's the retirement, but frequently the plan part's missing.
Yeah, yes, exactly.
It's a retirement hope, right? So EBITDA would be part of the planning.
Yes.
We'd convert that retirement hope into a retirement. It's one of the steps in converting it to a retirement plan.
Yeah. Okay. So let's get into it. EBITDA, EBITDA. Let's go through each one of them. I'll let you carry us here, Martin.
Okay. Well, it literally stands for earnings. In other words, profitability before interest, taxes, depreciation, and amortization. So it's what your profit would be if you looked at your P&L and did not subtract interest, taxes, depreciation, and amortization. Okay. So you are adding those things back. So if you look at your profit and loss statement at the end of the year and you have $100,000 worth of depreciation, which is not unusual at all for a small company. And when you're calculating EBITDA, you would look at your profit and you would add $100,000 to it.
Mm-hmm.
And the question is why? And why do people worry about that? I'll say two things start out with. EBITDA is one of two numbers that are, this is going to be simplified, right? But it's basically how it's done. EBITDA is one of two numbers that you multiply together to get the value of your company. Okay. So if you made $100,000 in the EBITDA in a year, and you look at the other factor, which is the multiple, it's how much the market will pay you. And let's say that's 4. So 4 times 100,000, your business is valued at $400,000. Okay. So the question goes back then to why earnings before interest, taxes, depreciation, and amortization. The reason, I believe, is that the financial market is trying to value the company independent of its current owner. Okay? So your company made a certain amount of money, but you had to deduct a bunch of interest. And that's because you don't have any money to put into business. Maybe you do, but you borrowed money. It was a decision or a necessity depending on you, not on the company, right? So they add that back. Taxes. Many of our listeners are sub-S corporations and LLCs, and there are no taxes at their company level. I mean, they're property tax and sales tax, but this is income taxes. So there's nothing to add back. But if you are a corporation and your corporation pays taxes, you add those back, and pretty much for the same reason. Taxes depend much on your choices as an owner.
And over the long term, the government and policies.
And it's just not going to be it's kind of independent of the company. The company made that money. Mm-hmm. Now it's got to pay taxes, and so might the new owner, but we're adding it back to keep it square, right?
Yeah.
So interest, taxes, depreciation. We're going to trust that our listeners know what depreciation is. It's how much you write down. So you buy a truck that costs $75,000. In the first year, you write off $50,000.
Yeah.
You expense it. And that goes against your P&L and it reduces your taxes. And oh boy, woohoo. But it reduces your earnings by $50,000.
Mm-hmm.
But that depreciation is a non-cash expense. It's a bookkeeping entry. And depreciation, whatever you buy, you're building long-term assets like buildings or trucks or vehicles or whatever you buy, does depreciate over time, right? A building much more slowly than your truck. So depreciation is a real legit thing. But the way depreciation is done, it's largely tax law, right? Everybody listening to us has done Section 179 or whatever it is, where you can buy a bunch of stuff and to write it all off this year. Well, it didn't really depreciate to zero in a year. That was a tax decision. So although depreciation is real, they add it back, okay? And the last one is amortization. Amortization is depreciation for non-tangible assets. So if you bought a franchise from somebody and you have a lawn mowing franchise, you paid $100,000 to get it. You don't get to write $100,000 off. You have to depreciate that. So amortization is depreciation for non-tangible assets. So that kind of makes sense.
Yeah. There's one other aspect of this that depends on the owner, but a lot of times it's referenced as SDE, seller's discretionary earnings or income or expenses even. The owner like to do massive pizza parties every single Friday. Well, it's not critical to the operations of the business or the team. The owner bought a jet ski to do some promotion on the lake. I don't know. Those would also potentially be added back, depending on exactly what it is. The owner decided to pay himself $600,000 in salary, but really for that role, it was $120,000 salary.
Right.
So those are also things to be aware of. A lot of times they're not necessarily going to be added back, but they're taken into the calculation by the people that buy. And typically the people that buy see that as an opportunity of, hey, we don't have to pay that much, and that's extra profit, whatever.
Well, you're at a really good point. You're one step ahead of me at this point, but let's just say you've got your earnings figured out, your EBITDA, and your profit and loss shows you made 100,000. Your EBITDA shows you made 200,000. Okay. So you're going to use 200,000 and you're going to multiply it times some multiple, which we use for, and you're going to get $800,000. What you're talking about and just referenced is absolutely part of negotiations. There's your starting point, a multiple and EBITDA. You're correct. And I think it happens every single time.
Yeah.
The seller goes in or has his representation go in and say, look, I have life insurance and you won't have that expense, so my profit should go up by that much. I bought a jet ski. You don't need that. It'll go up. You can hire my replacement for $100,000 instead of $600,000. And they do that. And they negotiate to make their EBITDA higher. And that's called adjusted EBITDA. But it goes the other way too, right? What happens more often is the owner doesn't pay an appropriate, maybe they're taking $50,000 and they're running a $25 million company. They're taking the rest out as draws. The buyer is going to say, you know what? I cannot replace you for $50,000. It's going to cost $200,000. So they reduce it. So that's what goes on in the negotiations. But you're trying to come up with adjusted in EBITDA. Some of it goes up, some of it adjusts down. So that being a little bit objective, meaning we have a method, a process. There are no laws about it, but that's the process that goes on between buyers and sellers. I want to say one thing here quickly to listeners who might have a piece of paper out and scratching out. Well, first of all, 4 is not necessarily a multiple. That's a nice, nothing special. That's a place to look at it. Companies sell for 2. Companies sell for 8. Really, if really hot markets, they sell for 12. I know one industry that was selling at 17 times earnings. But 4 is a place to start. But you sit there and you look at your earnings from last year, you find your amortization, you add that back, and you do some back scratching, and you go 4 times my earnings is $400,000. Go, hell, my building's worth $2.5 million. Okay, so the first thing is valuation of the business using EBITDA generally does not include real estate.
Yeah.
So that's separate. But here's something to think about. That's your building and you own it. You haven't been paying rent. The buyer's going to buy your business and they're going to have to pay rent. So they're going to reduce your EBITDA by rent, right?
Right.
But let's say you do all that math and you go, my company's worth $400,000. We're going to, oh, good. I don't have to sell my real estate for that. But I've got $2.1 million worth of trucks. Well, guess what? Your business is going to sell as the value of those assets.
Right.
You get either or, because when people buy your company, they're buying everything that it takes. This is a grand statement, but everything that it takes to reproduce the earnings that you're providing. That's your working capital. We talk about inventory, your equipment. If you have a bunch of trucks, your trucks.
Your people.
If you have a bunch of debt, your people. Yeah. If you have debt on your trucks, you got to pay it off. You, not them.
Correct.
So maybe we're getting too far afield because we're talking about EBITDA.
No,
anyway,
it's good. I think the next thing, like you said, 4 is a good multiple. There's other things that go, or the factors that contribute to that multiple is how many customers do you have, how diverse your customers are. If you get a bunch of your revenue from just one customer, then that's seen as a threat or a weakness. But if you have a bunch of diverse customers, no customer provides more than 20% of your revenue, for example, that's really good. If you have a recognizable brand that's distinguished in the marketplace, if you've got proprietary technology, that's a really good one, or potentially really good software. If you have systems in your business, what are some other things that contribute to that multiple?
The number one thing is you dependency.
Sure. Yep.
I mean, that they need to be able to have you walk away and they walk in and the company doesn't even know the difference. Right. You should, now that's what they want.
Mhm.
If that's the case, you're going to get a higher multiple
Yeah.
than if
Another
it's
good one
less.
is contracts. If you have really
Yeah.
good contracts with your customers, then that's seen as favorable.
Yeah.
A bunch of
The
other
world
things
right
that
now,
can increase or decrease your
right.
multiple.
And those are the things to know about the multiple in your business,
Mhm.
because those are the things, if you want to increase your value, those are the things that you need to work on, right?
Yeah.
You want to get your earning. That something I always say is let's say your operations are the same and therefore the multiple, they're kind of confidence. The multiple is really a confidence that they can replicate the earnings,
Mhm.
right? And then an applied rate to the earnings that they need to make as a return on their investment. But if you want to increase the multiple, you have to increase the buyer's confidence. That's an easy way to say it.
Yeah.
And then you also, if one thing that really matters is if you have above average profits, which is a signal that the systems that you're using to run your business are better
Superior.
than average.
Yeah.
Yeah, they're just better than average. That you have growth potential. You would look. One of the acid tests that I have when people talk to me about, can I sell my business or I want to sell my business? First question is, would you buy it? Hell no. That's why I'm trying to get the heck out of here. Right? I don't make any money. I got to say, well, you need to make it where you would buy it. I mean, if you're ready to go, it's not quite that simple. You're tired, but
Yeah.
then would you buy it? Do you think you could replicate your earnings indefinitely to justify your investment?
Yeah. No, it's a business worth selling is a business worth keeping, right?
Yeah.
So one thing I want to get into as we kind of wrap this up is really what this plays out like. And, if you're going to sell at a multiple for your EBITDA, there's typically either a competitor is going to buy you out or a private equity group will buy you out. Sure, there can be someone that's coming into the market and wants to buy a business and not start from scratch and just be an operator, but those are typically the methods that you sell. And I want to get into operational excellence with this, but let's explain what a roll-up is, how private equity works. Basically, a private equity group will say, hey, we understand how to operate a specific type of industry business. Let's say it's HVAC. We've got people on staff that have scaled HVAC companies. We know how to do it well, and we have all the people in place to handle the back office. We want to go and start acquiring HVAC companies and bring them under one umbrella so that rather than, let's say there's 10 HVAC companies out there in Texas, for example. Well, each of those HVAC companies is going to have someone doing HR, someone doing marketing, someone doing payroll, someone doing the anything that's overhead expenses, essentially. Well, what if we just had one headquarters for 10 different HVAC companies that handled all of the back office, and we were able to reduce costs because of that? But then we also have great systems and software and operational excellence to run those companies so we can increase the EBITDA. And then because we're making above a certain amount of revenue, we have a great multiple. And so we can sell it for higher than we bought it for. So essentially what they'll do is they'll find one of the HVAC companies that they feel like is the strongest one or going to be that pillar. They'll acquire it. They'll likely keep that owner on as a salary for a CEO position or whatever you want to call it for a while. And they'll even give that owner a stake in the private equity group for that project so that they are invested long-term. And then they will go and start acquiring other HVAC companies, bringing them under that one brand, scaling that brand, and then doing all of that so that they can increase the EBITDA by a certain timeline and then have a higher multiple, sell the company probably to another private equity group, but to somebody else, and through that make a lot of money and get a return on their investment. Did I explain that well? Anything I missed?
Yeah. There's a thing called multiple arbitrage,
Yes.
and that's kind of cool. If a company, I've seen this happen, but if a company has $25 million in sales and makes $100,000, okay, just 100, that's pretty bad.
As EBITDA
Right.
or net profit?
EBITDA, net,
Okay.
it's net profit adjusted. That's pretty bad.
Mm-hmm.
And you have a company that did $1 million in sales and made $100,000. That's pretty good.
Right.
The big company will get a higher multiple than the little company.
Yep.
Now, it's in the law, just observations, just because it's bigger.
The reason why is because look at the operational excellence. If we can become more efficient and reduce waste, then
Right.
let's say we can do that by 1%. Well, with the smaller company, 1% of $1 million isn't that much. 1% of 25 million is a lot more. It's 25x. Right. So if we can be 1% better, we can increase the EBITDA. Right. And so,
And what that does is, and you're correct, a lot of times private equity firms roll these things up, create something that's bigger to get the bigger number for a higher multiple, right?
Mm-hmm.
And that therein lies the kind of the neat thing about it. I can buy something from a small company for 3 multiple, put it into my big company that's been valued at a 7 multiple. I just more than doubled my money.
Right.
133% increase. Now you don't realize it. You don't get that money till you sell, but you've doubled your money 1.33 times, 133% of your money just by a financial engineering move, having bought a company at a lower multiple and put it in and aggregated it. Then typically there's the next larger private equity firm out there that's, trying to put together $1 billion deal and
Right.
$100 billion deal. Then, at some point they take it public and multiples are really high in the public. The price to earnings is not a direct comparison, but it's kind of a comparison to the high multiples in public markets. So
I've got a friend.
It's a whole new world.
I've got a friend that works for an investment bank. They provide extremely high interest credit with very little, basically they'll give it to anybody. Not necessarily, but basically, hey, it's really high interest, but you can have it. And really a lot of their customers are private equity groups that find this deal where, man, if we can add this company to our portfolio, it could be a huge multiple arbitrage for us, but we don't have the credit to be able to buy it right now. And so they'll use these high interest, we're talking like 33% interest loans that are due in a year. And they'll use that to buy the company, but because they have that company that added to their portfolio, it's increased their valuation tremendously.
And you just hit on something.
Yeah.
That these guys do. They pay way too much interest, right?
Yes.
But they don't care because it doesn't hurt their in earnings because they add interest back.
Exactly.
Right? That is financial engineering, and that's where people like me, I'm an operator guy, right? I want to see value. I want to see I spent this much money on inputs and the market valued my product this much more. I've contributed to the world and yada, yada, yada. That is a different mindset. I'll give you an example. Another place I know of, they were doing something and they were paying $9 million a year in expense for this to be done for them. Okay. It wasn't straight across, but I'll call it that way just for fun. They instead went out and spent $9 million buying assets to do that thing for them. Paid a bunch of interest. That's not an operating economic decision you make, but it added 9 million times their multiple, which is a bunch. I'm just going to say it's 7. So it added, $63 million to the value of their company by borrowing money and doing what an operator would say was an uneconomic thing. Okay.
Yeah.
Now, this is just fun to talk about. For our listeners, you want your earnings to be up. You want your multiple to be up. The last thing to say about it, you double your earnings and you have the same multiple, you've doubled the value of your company. If you double your earnings and you double your multiple, you have
4x.
4 times
Yeah.
the value of your company. And in 2 or 3 years, somebody who concentrates on that has a viable company now, can do those things.
Yeah.
But you need to be aware of it. EBITDA is just a starting point, and it's kind of a badge that tells people that we're entering that zone. Oh, I wanted to say on the banks. Banks aren't using it for value of your company, but they're looking at your profit and loss. And maybe you show a loss. They immediately look up and see that you had $250,000 worth of interest. They add that back and says, oh, you got a nice profit, right? So banks will look at EBITDA and more IBI, right? But anyway, they also use it.
Yeah. Well, this has been fun. I hope it's been educational for our listeners. I know I get a ton of questions from people about EBITDA and just a lot of uncertainty. Don't be intimidated by it by any means, and try to focus on a little bit. I think you'll find it fascinating of what really impacts the value of your business over the long term, and maybe think about that retirement plan like we talked about earlier. So thanks for all the insight, Martin, and the knowledge. You always teach me a lot.
It's fun stuff.
Please subscribe and follow us on all of our social media accounts. Pass it on to someone who you think needs to hear. Thanks, guys.
See ya.
Thanks for listening to The Cashflow Contractor. Check out our website in the show notes or visit thecashflowcontractor.com.